All right, so unfair discrimination. So do you have data to support different rates? Telematics is an interesting one. Some people think telematics is even, parents are using it to monitor their teenage drivers, not just to see what they're doing, but even see if they should be driving at all, because obviously it hurts their rates. We had a lady from USA come and talk to us, a former student from this class. She said so far USA has not used it in their rate setting, but they're collecting a lot of data to see if it does have an impact. I'd be curious, if you can learn to be a better driver. We are going to watch some videos I think you're going to find pretty entertaining of some really bad drivers. And if you watch the video, I actually recommend you watch these videos, not just for this class, but just looking at them. I think it makes you a better driver, because what you do is you notice certain things that are repetitive in the video. The biggest one we're going to look at is signal lights. Signal lights are incredibly dangerous, and that's the reason we have the roundabouts. The roundabouts by itself could be a really interesting topic for paper too. I don't know if it'd make an entire paper. A lot of people think, no, there's no way that's saving lives or saving property damage. But when you see the videos on signal lights, I'm going to show you two videos. I'm going to show you videos of many, many accidents of signal lights. And then I'm going to show you an accident at a roundabout. And guess which one was a fender bender and which ones were people losing their lives? The roundabout, it's really hard to go fast on a roundabout. So you can still have accidents and people do some pretty stupid things in roundabouts, especially the people that just keep going around. And other cars are like, why aren't you getting off? And that causes an accident because they get nervous, their GPS. But it's not serious accidents if you look at the death rates. But red lights, you look at these in videos. I've gotten to the point where when I come to a red light, I'm paranoid. It's like someone's going to fly through that. I'm stopping, looking, almost worried about the guy behind me. So, those kind of things, you start thinking about what causes accidents, where are they? If the actuaries can figure those kind of things out, then, they can price it. Intentional is, anything related to race, color, religion. And disproportionate impact is usually back related to the intentional discrimination. It's when a protected group, not always a protected group, they look at gender and age and some other things as well, but whenever a protected group is on average paying more for insurance, that's called disproportionate impact. But could it really be discrimination, or is it simply that there's something else, there's some other factor going on? It's obviously very disturbing to the industry. The definition is a lack of symmetry or unequal percentages, unequal distribution of each racial group within a given risk factor. It changes over time. It is not illegal unless it's an obvious surrogate for something sinister. I love that quote. So he kicked it out. You already saw that. So the goal of this study was two-phase. Phase one, univariate analysis. Phase two, a multivariate analysis. So the Texas Insurance Commissioner had to do this study by state law. They were required by the legislature to figure out if the use of credit scores was allowed by existing Texas law, which sounds more like a judicial question than a regulatory one. But they can disallow if it's intentional or unfair. They cannot if it's only disproportionate. So here's phase one, 2 questions in phase one. You want to get this in the exam essay. This is an exam essay. I used to have it as a paper. I used to do 3 papers, but I've converted this one to exam question. So you definitely on your answer, you want to be really organized. The Texas legislature asked them to do phase one. Phase one asks 2 questions. Is there a disproportionate impact for use of credit scores? And does the use of credit scores predict claims? And the answer on that is yes and yes. There is a disproportionate impact and it does predict claims. So then Montemayor, he was a really quantitative person. So his mind was probably thinking, well, maybe it predicts claims, but that's because it's coincidental with other factors also predict claims like age. So why are we using credit scores? Why don't we just use age? So phase 2 was a multivariate analysis. It said, and there's a few ways to put this, but do credit scores in conjunction with other factors provide additional information? Does that make sense? More information on top of what just these other factors provide. So it's not whether there's a relationship, we know that there is, but whether it's an important relationship. So the study evaluates if and to what extent credit scores enable an insurer to more accurately predict losses. Is it unique in some understanding of frequency and severity? And one thing on the exam you do want to talk about is, where does credit scores give you the most prediction? Is it severity? Is it frequency? Homeowners is a little tough on severity because you would think people with good credit scores have more expensive houses, so their severity should be higher. You might think the same thing on auto insurance, but you would think good credit score, wealthier, more expensive stuff, severity should be higher. But you're going to discover that's not the case. Severity is actually higher for people with lower credit scores, especially on auto, but frequency is the key. People with low credit scores file more claims, significantly more claims than people with good credit scores. But severity is in there as well. We'll look at it. It's not quite as strong on the homeowner side because of the mold issue. So they want to know, what is credit score just a coincidental variable? It's really just telling us something else. And it could be a coincidental variable on something that is illegal. If you could perfectly predict religion based entirely on credit scores, that would be illegal because religion, you can't do that. So if you can look at 50 credit scores, you know exactly what someone's religion is by credit score, that would be illegal, but that's not the case. There's people in every religion with good scores and bad scores, and within each one of those groups, the good scores drive better than the people with the bad scores. So there's this consistency that says, no, it's not just a substitute. And the conclusion was credit scores is parsimonious. That means it's effective. It's not a waste of time to do it. It does provide significant information. And what words did he use? Remember, significantly improves. So the conclusion was yes, yes on phase 1. And yes, it does provide significant information on phase 2. We'll actually look at the numbers. Insurers argue that it helps availability, so that's an important argument. So everybody's focused on affordability. So these people with low credit scores, they're probably lower income. If they're lower income, the last thing we want to do is charge them more for insurance, and that's exactly what we're doing there. Lower credit scores, probably lower income, so we're going to charge them more money. Insurance industry says, yeah, but if you don't let us do that, we won't offer them insurance at all, so then it won't be available. So people in lower income that have good credit scores, they'll be able to buy inexpensive insurance, and they get helped out. People with low income with bad credit scores are likely to be worse drivers, and they'll pay more for insurance, but that's because we have evidence they're weaker drivers. So that's their argument. Some people say the increased rates for policyholders with below average credit scores makes it unaffordable and even unavailable. So they argue you're not making it more available to everybody because people with bad credit scores, it's really not available to them because they can't possibly afford it. So this is true for other things. It's not just true of credit scores, but it is true of other things. From a society standpoint, if statistics say this group are worse drivers, shouldn't we want them to pay more for insurance? Shouldn't that be the case? Do you really want us as society to do whatever we can to keep bad drivers on the road? And I'll show you the really bad driver on this video, and you'll see, how scary it is. There's some people out there. I'm amazed on that TV show that the people go on that show and they're still driving afterwards. I can't imagine someone hasn't, like some police officer just doesn't wait outside their house and just arrest them the next time they drive, because they're pretty freaky, scary drivers. So, Are we piling on people in bad financial condition? We're charging them more. And then the key we're talking about with telematics is the false positives. Good drivers with bad credit scores, can telematics save them? If USA says, hey, we're not using it in pricing, then no, it can't. But there are companies like Root that are using it in pricing and are allowing for a discount, but you have to prove it first. You have to use the telematics for a few months, and then they'll let your rate come down if you're a good driver. More and more companies using credit scores makes consumers really upset because they question, what's the relevance? What does my credit score have to do with my driving? Actuaries say we don't care. We're not talking causation, we're talking correlation. And it is strong enough, our statistics say it's strong enough. Now, some of you, when we look at the second study, I've had actuaries say, well, it sure looked like there's some statistical weaknesses in the second study. And I will bring up the issue, you'll see in the second study, they make a distinction between statistical analysis and actuarial analysis. In my mind, statistical and actuarial are the same, but they make a distinction. I think part of it's related to jargon more than it is the actual math. So most people are okay with young people driving and paying more for insurance. I think almost everybody is okay with people with speeding tickets and accidents paying more for insurance. They're okay with that. Probably most people are okay with women paying less for insurance than men. There's not too many. They may say, a man might say, hey, that's not fair because I'm a better driver than a woman. Actually, you're going to say, well, as far as we know, you're not, so we're going to charge you more. Put this device on your car and prove it to us, and maybe we'll let you do that. But then everybody says they're a better driver than average, so, or most people do. So that's an issue. So I remember, I think I told you, WOAI had this, maybe it was Joe Pags. Boy, I haven't listened to Joe Pags in years. Is he still on radio? But he had this as an issue on his radio program. It came on right when I was leaving USA, so I listened to it. And he had a guy on with him from Allstate. I bet that guy wishes he had not volunteered, because the phone calls, they were 99% extremely hostile and negative. And that poor guy, he was so cheerful the whole time. It's like, oh yeah, I understand. But boy, they were beating him up left and right. Joe Pags was he did a pretty good job of trying to balancing it up, but they were really negative. The thing people are missing calling in, they seem to have this impression if you eliminate credit scores, the people with bad credit scores will see their auto rates fall. But what were they not mentioning? If people with bad credit scores, you can't use it so the rates fall, what also has to happen? People with good credit scores, their rates have to rise. There's no way around it. But no one brought that up. No one with good credit scores was calling in and saying, man, I really like this. This makes a lot of sense. Or saying, hey, if you get rid of it, I'm going to pay more for my auto insurance. There were none of those phone calls. So could there be some third variable, race, age, income? Could it be some variable as far as responsibility, conscientiousness? That people that are responsible and conscientious, they tend to have good credit scores and tend to drive better. And do actuaries even care? They probably do care, but their attitudes probably is. But we can't measure conscientiousness or responsibility. We can't find a factor for that. If we could, we'd probably do that because that'd be more socially acceptable. But we don't know how to measure that. So, but we do know the relationship. Does high correlation imply causality? So y'all probably seen some of these. Boy, the lady who spoke from USA, she had one on, who was the guy in the Constitution, searching for the Constitution movies? Nicolas Cage. Cage, yeah. She has some statistic on Nicolas Cage. I forget what it was related to. It was pretty obvious they weren't correlated, but the correlation was really, really high. And it's kind of humorous. And I don't remember, I had to email her and ask her what that was. But yeah, there are times where you get really, really high correlation entirely by random chance. Well, actuaries know that. They can test for that out of sample because, if Nick Cage makes a movie, I forget what it was, but it's something crazy of, the average consumption of tea in China was related to how many movies Nick Cage made, something like that. Well, if that's not true, then all you need is more data, because out of sample is eventually just going to fall apart and not be there. But and the actuaries say, hey, we've been looking at this time after time. We've looked at it in different areas of the country, even other countries. It's just consistent. There's a relationship there. There's nothing in the data that says, hey, this could be some random noise that we're picking up. So data mining, looking for patterns. Are you looking for causality? Actuaries aren't. They're just looking for some way that gives them a distinction in pricing. So if A and B are highly correlated to C, but C causes both A and B, but you can't measure C, you're kind of stuck using B as a surrogate. A is not causing B, B is not causing A, but C is causing both of them. So you know when A moves, B is going to move because C is changing, but you can't measure C. It makes perfect sense to use that in your pricing. All right, let's look at the study itself, because I think there's some really, really good charts in this study. So we'll start with phase one. I thought it was written fairly well. There's a bit of an excess on the charts. They kind of went a little overboard. But we'll just look at the highlighted section. So first of all, where do they get the data from? Well, they got the data from the industry. Does that taint this study in any way? Do you think the industry sent bogus information? Well, you saw the problem with State Farm, and they're kind of rigging the data, but this is coming from actuaries. Actuaries are somewhat purists when it comes to mathematics, kind of like economists. They probably sent the right data. The 6 leading insurance groups, which, obviously State Farm, Allstate, maybe USAA, maybe Farmers, 1.2 million auto and 800,000 homeowners. So pretty good sample size. And then there's the study. Does it impact certain individuals more than others? Obviously, it impacts people with low credit scores more than people with high credit scores. I'm not asking that. That's pretty obvious. But does it impact other groups, and does it predict claims? First, yes, it does have a disproportionate impact. The individual policyholder data shows a consistent pattern of differences in credit scores among different racial and ethnic groups. However, there appears to be a strong relationship. Remember, in the next study, he uses significantly. Here he says strong. To me, significantly seems stronger than strong. Between credit scores and claims experience on an aggregate basis, it is necessary to evaluate if and to what extent credit scores enable an insurer to more accurately predict losses. So they're asking that multivariate question. So he brings it up right here. Now, I don't know who raised it, if he did, if actuaries raised it, if legislatures raised it. They don't really say what the source of the second question was. All right, so how did they figure out some of these groups that are impacted? They couldn't get data on income. So what they did is they used zip code to try to figure out income. Probably okay on that. Averaging credit scores between income levels are not as large as they are for racial groups. The data does show average credit scores for upper income are better than those lower income. You're like, duh, but still, it's pretty amazing how many very wealthy people have bad credit scores. I've seen some of them on TV. And there's people who can make 6 digits and think they make 7 digits, and they spend accordingly, and it doesn't quite work out. The moderate income level populations tend to be overrepresented in the worse than average credit score categories and underrepresented in better than average credit score. Individual policyholder data shows a consistent pattern of differences in credit scores depending on individuals' age. Well, that's pretty obvious. Right? Young people are going to have worse credit scores, not because they're not responsible, because they just haven't enough time to build the score. The number of credit-related consumer complaints increased significantly. You would think so, right? Who's complaining? You think people with great credit scores, hey, you cut my premiums 40% because my driving has nothing to do with my credit score. I doubt they got any of those calls. And that, again, that's what people don't realize. There's a lot of people who benefited from this. We'll see how much they benefited, but there's a lot of people who benefited from this. Yeah, there's also people who got hurt by this. It's similar in California. In California, they had a proposition to make it illegal for insurance companies to charge people in the city more for auto insurance than people in the rural areas. People in the city voted 90-something% for it. People in rural areas voted against it. So what happened? People in the city saw their rates drop a little bit. People in the country saw their rates rise dramatically. Yeah, there's always winners and losers. Based on the review, insurers writing probably 42% of the homeowners and 55% of the autos, so these are significant companies, do not include those insurers whose use of credit information is to accept or reject application coverage. These percentages increase. So the question is, you know, some firms, and Allstate got in trouble. We'll see Allstate. Allstate says, hey, we're not using credit scores to price our policy. We're just using it to check if they're going to pay their premium. You know, if they got a bad credit score, they probably won't pay their premium. So we don't. So it's, you know, it's kind of like you got a bad check. You write bad checks, so we're not going to accept. The state of California said no. The state of California made use of credit scores illegal. They said no. Allstate, you're saying, hey, you got a bad credit score, you can't do business with us. Or I think part of what they did was they said, and we'll see the article, is you have bad credit scores, so you got to pay your entire year's premium up front. Which essentially is telling them what? Go somewhere else, because we don't want you. And the state says, no, you're essentially using credit scores to get rid of bad customers. All right, so how material is it? Rates vary as little as 11% to some insurers as much as 400%. You can actually see it in the table. That's the number of complaints. Well, we'll see it when we get to the data. So 400%, that's obviously an outlier. So we can't go with that one, but as little as 11%, but even 11% is fairly significant. You know, if you're paying $1,000 for auto insurance, that's an extra $100 or less $100. 400% obviously is probably the person's just not going to get the insurance. So there's the study, the 79th legislature had to do this. Credit scores are typically calculated. I don't know if any of y'all have dealt with credit scores. If y'all work at banks, it's just a massive statistical database, right? We have a former student, an alumnum. He went to work for Equifax. You used to think of Equifax as, you know, blood tests and those kind of things, but they're heavily involved in credit scores. And it was really interesting listening to him. Equifax, it was pretty humorous. Equifax had not hired college students forever. They didn't believe in it. And one year they decided to hire college students, and they came to UTSA. I don't know why. This student had applied there. They hired him, and boy, they loved him. And I was like, yeah, good job. First UTSA hire. And they were like, I love it. They were all fighting over him. His boss left to start a new firm. And his boss was begging him to go with him, and his firm was begging him to stay. It's like, hey, UTSA, good job. Way to kill it. So using a model, number of credit cards, number of collections, the output is a single number value known as a credit score. So people with a lot of credit cards, is that a high credit score or low credit score? You think that hurts? Does that hurt the credit score?
I have a lot of credit cards and I have a high credit score.
So it may or may not hurt. I've heard people say if you only have one credit card, it can actually hurt you because you don't have a lot of experience. Number of collections, obviously, if you're not paying your bills, that's going to hurt your credit score. But you get one number. How accurate is it? Well, one thing I think bothers people is the errors in the data. And Jacob, you dealt with that. But there are errors in the data, and there's been complaints that when there are errors in the data, they don't fix it. So you're kind of stuck with this error because no one wants to actually go in and fix the data. So that would be bad, right? If it's influencing not just your ability to get credit, but also influencing your auto insurance rates. You say, hey, fix the data, clean it up. What are you doing to me here? All right, so here's the complaints. 2002, large increase in complaints from both homeowners and auto, both. If you think auto would be more. The range and rate impacts. All right, here's what I was looking for. So this shows the impact The minus 10 to positive 10, that's about what, about 30%. So you can see the range, distribution impact credit scores and ratings. Chart 2 shows that as insurers started using expanding their credit risk, the vast majority of policyholders, 90%, experienced rate swings ranging from 40% decrease to 40% increase. Almost 10% of policyholders experienced more than 40%. What do you notice about the skewing on this? It's skewed to the right. So there was people that were harmed much more on the upper side. You know, it's kind of a big group bunched right here. So people with good credit scores, they're seeing a 20 to 30% reduction. And that's pretty good, right? I don't know what auto insurance rates, maybe, you know, I don't know what y'all pay if you're under 25 and a male driver. I'm scared to ask what that number, but if you're paying $2,000 a year in auto insurance, 20%, that's a pretty significant amount. That's $50 a month. That's a pretty good savings. But there's this group up here, 40, 50, 60%, more than 60%. They're really feeling it. They're seeing an extra $60, $70 a month in premiums. The homeowner impact was not as dramatic, 90%. The increase was only 30% or less. So here's the distribution on the homeowners. You can notice it's not nearly as skewed. From an availability perspective, insurance companies argue that the use of credit scores improves their ability to measure risk and therefore allows them to expand what they write. This benefits consumers because insurance may become more available and may be particularly beneficial to marginal applicants who might otherwise be declined. On the other hand, the increased rates for policyholders with below average credit scores may make insurance unaffordable and essentially unavailable. Note that this outcome could occur with other variables as well, so it's not just credit scores. So anytime you're rating people, it's going to harm some and help some. Some consumers may question the relevance. In contrast, other things it's not. We talked about that. You can get into some of these things are, you know, they're just telling you in detail how they fix the data. Some of it is a little bit disturbing because, you know, they didn't have the data they wanted on certain ethnic groups and other things, and they just kind of guessed and made certain assumptions. You know, there are some issues in there. Here's the breakout of the groups. Some of these charts, I tell you what, I have to look at them like for 30 minutes to figure out what they're saying. So I don't know who put the charts together, but some of them are a little bizarre. Now, what they're trying to do here is also look at income versus credit scores. To me, I need the numbers. These bar charts, they're not stark enough for me to really tell what the difference is. Same thing on age. Insurance risk was measured by either pure premiums or loss ratios. All right, so this is pretty important. What's a pure premium? What's a loss ratio? And when do you use one versus the other? So the footnote will tell you a pure premium, in my life insurance class, we called it the net premium, but the pure premium is what would your premium be if you're only charging for claims? You didn't have any expenses, you didn't have any profit. How much we did charge to the company, just whatever premiums they take in plus any investment income, you know, the float, minus what they pay out, so everything in time value money, you end up making exactly zero. That's the pure premium. The loss ratio, that is your losses divided by your premium. All right. So pure premium, loss ratio, I can't remember which one they used for which. For personal offset, pure premium, I think for homeowners, they use the loss ratio, and for auto, they use the pure premium. A pure premium of $200 means that on average, insurance claims are $200 per vehicle per year. So they exactly break even. There's no profit. Loss ratio is the dollar amount of losses divided by a dollar of earned premium. We'll talk a little bit about earned premium versus written premium, but it's not a huge difference. A 70% loss ratio means that we'll talk about what incurred losses means, amount to 70% of premiums. If you've been following the healthcare debate, there's a law that requires insurance companies to have a loss ratio of 80% or higher, which means if you pay them $100 in health insurance, $80 of that has to be spent on healthcare claims. So 70%, and that's probably pretty typical for a homeowner's policy. All right, so here's a really important chart that you probably want to put on your exam. This is personal auto insurers, pure premium versus credit score. So the higher the pure premium, the higher the frequency and severity. The lower the pure premium, the lower. So the people over here are costing the insurance company on average $360 per vehicle per year. The people over here are costing the insurance company, what, about $175 pure. So pretty significant, right? Pretty hefty difference there. And here's the credit scores. I don't know what a 1 represents and a 10 represents. I don't know what their typical range is. Fairly significant. And then not sure. The people where they have a score, boy, it looks like if you have a bad credit score or we can't find a credit score for you, you're a pretty risky driver, because those people are way up here, pretty comparable to the category 2. So fairly significant. It's hard to tell, because the range, if we change the range here to 150, it would be much, much, much starker. But think of it in terms of 175 versus 350. There's essentially 100% difference in those. People with really, really good credit scores should be paying about half of what people with really bad credit scores should be paying. So it's a fairly significant difference. All right, so homeowners didn't lend itself to pure premium because of the difference in insured values. I guess that kind of makes sense, right? Yeah, that makes a lot of sense, because pure premium, big houses are going to have much higher pure premium than small houses. But if you do it as a ratio, losses to premium, your big house will have a whole bigger premium, so your loss ratio will adjust for that. So here's the homeowners. It's much starker for the low, but then it's kind of flat after that. The department also looked at claims frequency and severity. So you want to get this in your answer as well. So the question is this mainly frequency or mainly severity? The data shows credit scores has a stronger relationship to frequency than severity. I think it's got to be because people with high credit scores must have more expensive cars and more expensive houses. So I think that's got to be part of it, because that would increase severity. As the credit scores improve, the frequency decreases. People have fewer accidents or claims. Severity may decrease as well, but not at the same rate. For the same data sets, severity is nearly, for some data sets, severity is nearly flat. So there's a strong relationship on frequency, not as strong on severity, which seems to make logical sense to me. Now, some of these charts also stand out. I mean, look at that chart. What relationship do you see there? We don't know what group this is, group B, but claim severity versus credit score, is there a relationship there? Sure doesn't look like much of one. Looks like a flat line to me. So, and unless you have no score, again, if you have no score, don't insure those people. The issue is not whether credit score is related to claims, but whether credit scoring provides additional information over and above, which can enable insurance. So again, he's setting up the second study. I don't care if you look at the appendix. I think these charts, again, are really tough to read, so you can ignore the appendix. There's not any chart in the appendix I find interesting. I mean, you think it's interesting as, different races and how these numbers look, but the top of the chart here, I just think it's really hard. You can look at it if you want to and try to figure them out. There's a bunch of them because they have all these different groups, which you might not care about them. So, over and over, just ridiculous number of charts. Real colorful, real pretty charts, but I look at them as like, I'm not really sure a chart like that was the best way to display this data. All right, so there's the first study. No doubt. For auto, the vast majority of policyholders experience swings of 40%. For homeowners, it's more like 30%. Auto, they use pure premium, which is essentially just frequency times severity. Homeowners, they use loss ratios. They're not looking at the actual premium charge because firms have different expenses and different profit motives. So they're just looking at the pure premium, which is interesting because that means the actuaries make a distinction in their premium setting of exactly what's the pure premium and what's everything else. They definitely have that distinction. So by its nature, everything actuaries do have a disproportionate impact. It's just impossible not to. So if the state were just come in and ban credit scores, there'd be a lot of upset people because their rates would suddenly increase 30, 40%. And when they call the insurance company and say why, it says, well, you have a really good credit score, but we can't give you credit for that anymore. Be interesting to see what the reaction would be of people going, "Are you what? You're penalizing me because of a good credit score?" No, we used to reward you for a good credit score, but now the state says we can't do that anymore. So why can't you lower my rates for the good credit score, but not charge people with bad credit scores? It's like, that's not possible. We go out of business if we do that. So we'll talk more about this because this is an important concept of finance, of property casualty insurance. And rates would change really quite radically pretty quickly. That might be another good discussion for paper 2 is what happened in California when credit scores were made illegal. What was the reaction? You know, it's the same thing with what happened when they passed a proposition where you couldn't charge city dwellers more than rural drivers. You know, these are having impacts on people that are both positive and negative. Credit scores have a correlation, both frequency and severity, but more so the frequency. Is there disproportionate impact? Yes. Are they a surrogate for something more sinister? No. Do they provide significant information? Yes. Let's look at the second study real quick. It is a shorter study. What I want to do in the second study, though, is there's some statistical stuff in here. It's been a while since I've had statistics. So some of these terms are not terms I use normally anymore. All right, so here's the result of the second study. Credit score was related to claim experience, even after considering other variables. This means that credit scores provide insurers with additional, this is a great phrase, additional predictive information distinct from other rating variables. I should have put that in the class notes. That's a really good phrase right there. Additional predictive information distinct from other variables. Just perfectly worded there. By using credit score, insurers can better classify and rate risk based on differences in claim experience. I mean, this word right here, predictive. They're saying it's not just some random relationship. It's actually predicting the future. We actually can predict what's going to happen. For personal audit, credit score was related to the probability of filing a claim, which is frequency. The department found very little or no statistical evidence that credit score was related to the amount of claim or claim severity. That's a little different than the first study where they said there was a relationship to severity. So here in the second study, they make some adjustments. They didn't find that. Homeowners, credit scores related to frequency. Found some statistical evidence that credit score was also related to the amount of a claim, but was unable to draw a definitive conclusion. Why? Because of mold and hurricanes. Those two things distorted the data, and that made it more difficult. For personal auto credit, auto liability, credit score varies in the importance depending on the model the insurer is using, but generally comparable to the importance of territory and driving record. I mean, think about that. You would think driving record would be really pretty crucial, right? People who speed a lot, people who have accidents. But they're saying credit scores is comparable to driving area and to territory. So do you live in the city, you live in the country? Only class, which is age, gender, and marital status, was consistently more important than credit score, driving record, or territory. So it's kind of second to age and gender, but it's up there. For homeowners, credit score was one of several important rating variables. However, the department was able to draw a definitive conclusion of the relative rank due to the uncertainties of mold and all the others. For both liability, auto liability, and homeowners, the difference in claims experience for credit score was, we use substantial, significant, strong. He likes S words. Surrogate for something sinister, but you know, substantial. He's saying it's important. had a student write a paper for this class talking about how credit scores had no relationship to insurance, and that the insurance industries are evil for doing that. I was like, where did you get your data? He didn't have it very well documented. I remember talking to actuaries at USAA. I said, what's the debate here? And they're like, there's no debate. We are 100% certain there is a relationship. I mean, they're like, yeah, there's no doubt in our minds. It is important to ascertain whether the relationship between credit score and claim experience provides significant additional information over others. To this study issue, the department conducted this study. The methods. All right, so let's see. I haven't gotten a really great answer on this yet. The methods are categorized as being either statistical or actuarial. Anybody want to explain that? What's the difference between statistical and actuarial? Aren't all actuarial methods statistical? Are they like, are they looking at the stars? So they're doing some astronomy. Is that what actuaries are doing? So we use some statistics, but we like astronomy too, or what is it? So my guess is what they mean is there's certain types of statistics that actuaries use more dominant than maybe a typical statistician would. And since they're more related to actuarial, we'll call them actuarial. Whereas the more basic statistic stuff that you see in your stats class will make that statistic. That's the best I can come up with, that actuaries do have some special analysis. They don't really explain that here. All right, so the distribution is important. What distribution you assume. The actuarial methods calculate relative claim experience by rating variable directly from the data and were used to cross-check the conclusions of the statistical analysis. Again, I don't really know what that means. I haven't had anyone give me a good explanation.
Statistical work, when you said it started with like a hypothesis, was it actuarial?
Maybe I can't see that in this particular sentence, but there might be some of that where they're doing a lot more artificial intelligence, just looking for some relationship. Yeah, I don't know. It seems strange to me to say there's a distinction between actuarial and statistical. How many classes do you actuaries take that are pure actuary classes? Do you take actuarial science classes? Exam prep class. And who's that? Who teaches that? Is he an actuary? Okay, so that's good. All right, good. Yeah, I mean, you're taking a lot of stats classes from people who probably have no background in actuarial science, and it's kind of my argument is when you have a stats class for finance majors taught by finance people, rather than in the math department, because it is different the way we look at things. All right, here's the rating variables. I think this is pretty interesting. So they actually tell you down here what each one of these things do. Territory is where your car is garaged. So if your garage is 2 feet outside of Bexar County, your rates will be much lower than if you're 2 feet inside Bexar County. Even if you live 2 feet outside of Bexar County and drive into Bexar County every day to work, that's territory. Territory for homeowners should be pretty obvious. Class is age, gender, marital status. Why marital status? Who drives better, married people or single people? Married people. Why is that? The reason for that? Well, I think even if you just for age, married people still drive better. Married 40-year-olds drive better than single 40-year-olds. Because they have kids in the car, because they got a spouse that's say, hey, can you slow down? The spouse sits in the passenger seat like that. It's like, obviously, you're driving too fast. I don't know. I can give you my own personal experience. I have an older brother that I refused to ride with when I was in high school because I thought I was going to die every time I got in his truck. I picked him up from the airport a couple years ago for a surprise birthday party for my mom, and he was like, "Slow down, Ron. What are you doing? Slow down." He was like this old fuddy-duddy. He drives very conservatively now. Is that aging, or is it because he has kids, or he has a wife that's telling him you got to slow down, I'm divorcing you, kind of thing? I don't know, but they do drive better. Women drive better than men. young people drive worse than old people, but there is a shift. You know, at some point, somewhere around 80 or so, my mom is not allowed to drive anymore. We took the keys away from her. She cannot drive anymore. So there is a point where that changes as well. I remember driving down Fredericksburg Road at 45 miles an hour, and I see this elderly woman pulling out, so I change lanes. And then she kind of gets in my lane, so I change lanes. She goes to all 3 lanes, goes right out in front of me. I hit the brakes, my car starts spinning. I go over the median, go back over the median, go back over the median, and stop facing oncoming traffic. She never knew she did anything. She couldn't turn her head because she was like 90 something years old. She just pulled up, she says, I'm 90 years old, I'm going. And I wasn't speeding, you know, I kind of saw it. I knew that was going to happen, but I kind of assumed she's going to come 2 lanes over. But when she came 3 lanes over, I had nothing to do. So yeah, I mean, age, we become worse drivers at some point. Protection class, this is really where you're talking about homeowners. How close are you to a fire station? Construction, homeowners obviously is house made out of brick or wood. Basic or higher limits for whether policy are involved, or they have the minimum limits, or do they have higher coverages? Amount of insurance refers to the insurer's value of the residence structure. So a lot of this is homeowners. Driving record, at-fault accidents, serious vehicle-related convictions, you know, DWIs and those kind of things. A statistically significant relation river. Okay, so those are the classes. Oh, I think people with higher limits would probably drive better. So I would think when that gets back to the responsibility, if they have higher limits, they're not just thinking about themselves, they're thinking about society. Is, hey, if I cause an accident, I want to make sure I can pay for it. Whereas lower limits is saying, hey, if I have an accident, I'm just going to pay the minimum, and if it's not enough, that's their problem. That to me kind of fits into that responsibility. I don't know. You have to get the data. They may share that in this study. I just haven't looked in those details. This is the limits. So how much do you have $300,000 or do you have $100,000 or $50,000? One thing I don't understand here is that age to me seems to be in here twice, because what did we say was in class? Age. And then age is here again. So you young people, it's like, man, they're just going to charge you over and over again. Multi-card discount, auto home discount, driving record points, and your credit score. That's in there. Territory, protected class, construction, amount of insurance, existence of the discount, your deductible. You notice deductible is not over here, and credit score. And you notice on the auto side, we're talking liability. On the homeowner side, they're talking liability and property. On the auto side, it really focuses on liability.
When California, you say California made it illegal to use credit score.
Right.
Do you think that if insurance company needed to have more than 20% for underwriting profit, do you think that that would subsidize other states?
Oh yeah, there are definitely people buying auto insurance in places like Montana that are paying too much because states like California refuse to let them charge as much. Yeah, the problem is there's not enough people in Montana to offset it. So insurance companies, if you go to the Insurance Council of Texas seminar or symposium, they've had presenters who really look at state by state, and there are states where you don't make money on homeowners. There's states where you don't make money on auto. In some states, like Florida, you make a lot of money on auto, but you lose money on homeowners. Other states like New Jersey, you make money on homeowners, but you lose money on auto. And insurance companies, they just try to somehow, and it's true for all companies. It's not like State Farm makes a lot of money in California, but not in Florida, but USA makes money. You know, it's the same for all companies. They just learn to live with it. It's unfair, but it's just the way it is. All right, so special evidence for the conclusion was as follows. In every case analyzed, the statistical approach identified credit score as being related in a statistically significant way to claim frequency. For homeowners insurance, the department concluded that credit score was one of several, but it couldn't give a definitive. A small number of large claims accounted for a large portion of the claim experience in homeowners. That's where we get back to the hurricane and the mold. we saw the Ballard case and how important that was. When water damage and water-related claims were excluded, the average rankings placed credit score as the most important variable, followed by territory and deductible. So that's pretty significant, right? So when you take out the Ballard case and these other big claims that were just saying like these freak accidents, yeah, credit score is actually pretty high. All right, all right, so when you bring all these things together, there are 50 territories. This is state of Texas, 20 classes. When you mix all these together, 5 driving records, 10 credit scores. You saw that, I don't know why they break them, but 10, they put them into different 10 groups. There's only 2 on the multi-car, only 2 on the companion policy. Past claims history, they have 3 groups there. Type of vehicle, 3 groups. And insurance companies don't like new policyholders. What they know is if someone has a really bad problem, they're really bad insured, they tend to fire their insurance company and go find another one. So it's insurance company, if you quit Allstate and go to State Farm's like, okay, why did you leave Allstate? So that's a negative one. When you bring all those together, there's 3.6 million different categories. And so, yeah, I mean, do they actually have, I don't know how many people live in Texas. It must be 30 million or something. So you could actually, every 10 Texans could be in a different category. I doubt some of these categories are utilized all that much. I don't know where those territories are. Some of them probably have very few people in them. But you could have 3.6 million different categories. So, this is a lot of data. When you try to figure out, does credit scores add additional information over and above, if credit score is 10 of those, then, you've got maybe you still have 3 million other combinations, and they're saying you put credit score on top of that, it's telling you more information. So it's pretty important. That's just on the auto side. All right, let's get into some of these statistical terms. I can never pronounce these correctly, so we'll see if I can get it. Regression analysis identifies and measures the relationship between dependent and explanatory variables. It doesn't tell you causal relationships. All right, so I can never remember how you say this word. Hosan. Is it like a French word?
Someone's last name. I don't know.
Oh, okay, that's why it's capitalized. All right, so they use this distribution. Actuaries, why do you use this distribution and not normal or? So sometimes, when you look at auto insurance, normal doesn't make a lot of sense because it's not like a car's gonna be worth 40,000 or 20,000. Right now it's 30,000. It's what it is, and you lose. So it is somewhat on the downside, right? You don't have a lot of upside, so that might have part of it. It's used in other insurance and non-insurance applications. It was found to be the best approach for account for varying policy periods. I don't know why that's the case. The generalized linear model using a gamma distribution, all right, actuaries, you know what that means? Y'all studying that? Generalized linear model, I guess that just means, yeah. Gamma distribution was used to analyze claim severity because it is one of several models commonly used for such purposes. In addition, the exploratory analysis indicated if other reasonable distributions were used, similar results were obtained. So it's like that's the only one.
Distribution is also a right skew, but the more you change gamma, the less skewed it becomes.
Oh, okay. The distribution implies that the expected number of claims is proportional to the length of a policy period. It's commonly used in insurance models. So there's something going on there on, time as well. Department noted that some statistics indicated the actual data was less dispersed than expected. The department did exploratory analysis and make adjustments for this and determined that the degree of statistical significance indicated that statistical models used in analysis tends, if anything, to be understated. Gamma probability distribution with adjustments reflecting impacted deductibles and policy limits. This distribution usually is commonly used to model the severity. Assume average claim amount for a given policyholder is a specified function of the rating variables. With these assumptions, statistics were calculated using good old SAS to determine the parameters in the formula. relating to rating variables to be expected claim severity, as well as the test statistical significance of relationships. So, I mean, this is what actuaries do. The chi-score, boy, I remember doing those in college, but don't ask me now. We don't do that much in finance. Used to evaluate whether a set of rating variables were statistically significant as a group or individually. So you can read through that. Y'all do this in college, right? Even you finance majors do some of this, right? When you did this, did you find the financial application? Did your professors talk about that? That's a good question in the class, right? How can I apply this to finance? The statistics used were deviance and chi-squared. The reader may be familiar with R-squared. This statistic was not used because it is not applicable to the type of regression that was employed. Because it is so commonly used, the department offers the following observation. You can see what they said on the R-squared. These simulations illustrated the very low R-squared statistics typically resulted even if the regression model exactly mirrored the process. The examples also illustrated that regression models accurately measured the underlying variables and their impact was even when R-squared was very low. So, you know, the stuff we do in finance doesn't seem like our statistics should work well in this particular study. All right, and that's the end of it. So, you know, this, hopefully you're seeing stuff you're seeing in your stats class that, you know, it's not like you can graduate and then you go off in this entirely new world where you don't use anything from undergraduate. So hopefully you'll see some of this stuff and be able to use it. All right, so that's it. That is credit scores. I want to talk a little bit about telematics. I can see if I can get this article to work just real quickly. Some of y'all may want this for your second paper. Oh, before we do that, let's look at one. I want to look at one last article. This third article on credit scores talks about the California experience. So Allstate got sued back in 2004, agreed to pay $3 million, not a big charge for Allstate, because they used credit score information as a reason to deny coverage. So they weren't using it to rate the policies. That was illegal. So you couldn't charge someone more or less, but they used it to deny coverage to at least 1,000 California car owners. That said that they violated Prop 103 by redlining poor and minority motorists. The 1988 ballot initiative prohibits the use of credit histories as a factor in setting auto insurance rates, and Allstate said, we didn't do it. We didn't do that. We just said you have a bad credit score, we're not selling you insurance. We didn't change our rates. Although they agreed to the settlement, they denied it broke any laws. Insurers claim there is a connection between a person's credit history and the likelihood they will file a claim. What is that? Frequency or severity? Likelihood he or she will file a claim is frequency, right? John Garamandi, man, if you work in the insurance industry, back that time you knew this guy's name. California decided, hey, our insurance commissioner, let's make that an elected official. So you're running for insurance commissioner of California. What's going to be your platform? Lower rates. What else is your platform? There is nothing else. Lower rates. He contends that using credit scores to make decisions on insurance is discriminatory. Absolutely it is. Does the insurance industry deny that? No, everything they do is discriminatory. Age, gender, it is discriminatory. That's what we do. It's like, wake up, John Garamandi, you're a commissioner, state insurance commissioner. How did you not know that? So this is even, I think, an even more ridiculous statement. You cannot use credit scoring in California until you prove it is not discriminatory. You can't discriminate in California unless you prove you're not discriminating. That's essentially what he's saying. That's going to be really, really tough to do. Now, I think what he's actually saying is you can't use credit scores unless you can prove it doesn't disproportionately impact certain groups over others. And obviously they can't do that because it does. The company used a variety of methods, including checking credit scores, required 100% down payments. So that was what I was talking about. 100% down payments. That's going to be pretty discouraging. Would you want to pay your auto insurance all at once on January 1st? that would probably make you go to another company, which is exactly what they're saying Allstate was trying to do. Allstate, California's fourth largest insurer, said it used credit scores to determine only down payment amounts and payment plans, not the rate coverage. Eller said that using credit scores when selling insurance was a particularly insidious practice that made it hard for lower income motorists to obtain legally required auto insurance. And that's the other issue people have here. The state says you have to have auto insurance. And some people say, okay, I can't afford it. They say, no, you have to have it. And they say, okay, well, I'll go get it. And then you discover, well, I have bad credit score because I can't, and I'm good, low income. Where you're going to pay 40% more. It seems unfair. Even if they had no history, and that's true, right? A really good driver has a bad credit score, and the insurance company charges them 20, 30% more. He likened it to redlining on a map around poor communities to refuse to sell them. Jesse Jackson, I don't know if you remember him. I think he's still alive. I saw him in the news that he's having some pretty serious health issues getting up there. But he was pretty prominent in political scenes like there. He met with the insurance industry on this very issue, and they actually had a pretty good conversation. This is an issue you got to address, and he understood why the insurance industry is doing it, and he understood why he was concerned about it. So there was some give and take on this discussion. It hasn't resolved the debate about using them when rating risk for homeowners. So California is still okay with it for homeowners, but you can see it's the debate there. Allstate said it would continue to press nationally for use of credit scoring for both auto and homeowners. Using credit scores increases the accuracy, controls, what word is about to come up? Available, right? Insurance industry, they always use that word. Increases the accuracy of our evaluation, controls the cost of insurance, and help us make insurance more widely available. Said, great last name, Lisa Wanamaker. I love that name. So, yeah, it's an issue in California. It could be a paper 2 topic if you could find data. It's kind of an old topic from 17 years ago. All right, well, let's stop there.